Hello people, I'm Oji Onikashuku Prosper and you're welcome to Starlight Forex Trading, where we talk about technical analysis, trading psychology and money management. In today's video, I'm going to be giving 3 reasons why most Forex traders lose, the honest truth. If you've blown accounts, felt confused or followed many strategies with no consistency, this video is for you. Most traders don't lose because Forex is hard, they lose because they focus on the wrong things. Let me explain the reasons from experience. Reason number 1, no structure, only indicators. Most beginners jump from indicators to indicator. RSI today, MACD tomorrow, another strategy next week. But price moves by structure, liquidity and behavior, not indicators. Let me show this with chart. Now, if you look at this chart, you are going to see that the market is in a choppy or sideways market, okay, where the price is moving in an irregular manner. In fact, there is no structure here, okay, and you don't want to trade, in this kind of market. You want to wait for you to have, the market trending, either trending upward or trending downward. Let's if I go further, you see the price is going up and down, going up and down. Then before it broke this structure, the price actually broke the structure. I'm going to show you with let's say trend line. I'm going to show you with trend line. See the price broke the structure. Price broke the structure to the downside. Okay, now it broke the structure to the downside and then came up again. It's actually choppy. Okay, then if I should put the trend line, this trend line here, you see that it breaks structure again, okay, and actually came down again. If you, let's say you take a trade at this point, let's say you take a trade at this very point, took a trade at this point, okay, now you believe that the market is going to continue going up. Just imagine, pushed up and then came down, swept liquidity around this point. Even around this point, even if you look at what happened here, it pushed up a little and then came down to sweep all the liquidity. It just means that all your gains were gone. Okay, all the profit you had as the price moved from this point to this point was lost. You don't want to be trading this kind of market, okay? Because this market is going to give you a lot of losses. Okay, look at what happened here. Like I said, the price came to this point, and pushed down. So this is a shopping market. You don't want to be trading in this kind of market condition. So, but what kind of market condition is good? Okay, this kind of market condition is what you want. Okay, when the market is going up like this. Okay, if you see, okay, this is actually a shopping market. All right. So at this point, we have a trending market. You see, from here, from this point down to this point, market was trending. Now when the market is trending, what it does, it pushes down, breaks structure. You can see the market broke structure at this point. Okay, it pushed up again, went down, pushed up, went down. So when the market is trending down, it will be making lower lows. Okay, making lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. This is a downtrend. Okay, so it pushed up again and kept going down. This is the kind of market that will give you a lot of profit. So the market is going to pay you if you are patient, if you patiently wait for this kind of market condition. Okay, it kept going down. This is a very nice market condition. It's very nice trending market, downtrend. So it came down, broke this structure, came down, swept liquidity, tapped on this supply zone, and then pushed down to this point. This is the kind of market that you should be trading on, not shopping market. Okay, there are 3 types of market actually. You have the sideways or shopping market, you have the uptrend, and then you have the downtrend. You have the downtrending market.
Now, another reason why most traders fail in trading is because of over trading and impatience. The market doesn't pay you for effort, it pays you for waiting. Many traders enter 5 to 10 trades in a day when their strategy allows maybe one or two. For example, let's look at the chart.
Okay, as an example, this is a gold XAU USD 4 hour time frame. Okay, let's assume I want to do a trend line trading strategy. All right, so I'm going to use a trend line. I'm going to connect this higher low. Okay, and then connecting this one again. Okay, then after connecting this, I'm going to wait for the price to come back to this trend line. Okay, so like for example, if what we're saying now, the price came to, okay, the price came down here, respected the trend line once more, and then the third time it came, it gave us a buying opportunity. Okay, the price pushed up even up to this point. All right, so if I'm to take this trade, I'm simply going to place a buy trade here and put my stop loss. Okay, let's say I'm putting my stop loss under this protected low. Okay, and then I'll put my take profit around there. Okay, so we're looking at it, this is more like a risk 1 to like 2.5. Okay, then if I allow my trade to run, you see it pushed up, pushed, and it take profit. All right, so this is a very good trade, and this is a clear uptrend, and this is a very good signal. Once you see this kind of trading opportunity, you have to take it. Okay, and this is based on the trend line bounce trading strategy. Okay, where you connect two lower lows, sorry, you connect two higher lows. Okay, and then you wait for the third one. Once the third one touches the trend line, it gives you a trading opportunity. Right, but okay, this is an opportunity, to actually make money. But let's see, you continue trading and then kept trading. The one trading is not enough. Okay, you connect the trend line. Let's say you connected this trend line, connected this use the trend line to connect this higher low, and then you connected this one as well. Okay, after connecting it, you are waiting for the price to come, to come and touch the trend line again. Okay, so you place your trade. Immediately the price came down, you didn't even consider the momentum of these moving candles. These candles are moving down. Let me quickly show you with the cursor. Okay, these candles that were moving down, you didn't consider it. Okay, you didn't consider them. So the price just actually, okay, let's say the price came to that level, came to this level, price came to this level. Hmm? Came to the down to the trend line. Okay, so you place the trade because you believe that the price is going to bounce, it's going to bounce the trend line and go up. Okay, but that was not the case. Let's say you place a trade here. Let's say you place a trade. Okay, decide that, okay, I'm going to buy here. I'm going to place my take profit here, my stop loss, sorry, and then I'm going to place my take profit around here, and the price went against you. Okay, the first trade was a profitable one. The second one was not profitable. So taking many trades is not advisable. Is okay to take like one or two trades, but when it comes to taking 5 to 10 trades, it's not okay. You have most of the trade are going to give you losses. So it's not okay if you take many trades.
Now, a third reason why most traders lose in forex trading is because they don't practice proper risk management. For example, you can win only 40% of your trades, lose 60%, and you will still be profitable. Let me explain something. There's what we call risk per trade. You can decide to risk, let's say, 2 or 3% of your equity, which means if I have $100 in my account, I can decide to risk $20. $20 is like 20% of the $100. Or I can decide to risk 2%. 2%, which is $2. Now, for every trade I make, if I'm using risk 1 to 2, the RRO multiple, which is the risk to reward multiple, for every trade I make, if I lose $2, for example. Then if I win, let's say I'm using risk 1 to 2, I'll win $4. Then if I'm using risk 1 to 3, I will win $6. That is proper risk management. But most traders, what they do is they'll just go into the market. Once they see that the market is going up, they'll just buy. They will not, no stop loss, no take profit, which means they don't know the level to which they lose when they lose, and they don't know the level, the amount they are going to gain. They just allow the market to go up or to go down. That's why most times they'll blow their account and then you start blaming the market. And one thing I would like for you to understand is that forex trading is simple, but it is not easy. You need to have a firm understanding of market structure. You need to know when the market is in an uptrend, a downtrend, or when the market is ranging. You need to understand support and resistance levels. Okay, and with your knowledge of market structure backed up with patience and discipline, you'll be able to beat any secret strategy. Right now, in my next video, I'm going to be explaining market structure in the simplest possible way. Now, if you have found any value from this video, I would like for you to subscribe, share, okay, and click on the notification bell so that whenever I make awesome videos like this, you'll be the first to know. Thanks and bye bye.